Hi, everyone. I'm Rick Bensignor. Today is Tuesday, January 19th, and welcome to this week's In the Know Trader Show. Got a lot on tap for you to go over in our 30 minutes together. In the trader education portion of our show, which is usually how we start things off, we're going to talk about how to buy into strength. And it's one of the more difficult things to do as a trader. And I'll give you some strategies that I've developed over time that at least lets me participate in a rally that's kind of moving up quicker than I'd like it to. In our market overview this week, we'll take a look at the Qs, which is, of course, the tracking ETF for the NASDAQ 100. We'll take a look at the TNX, which is basically a chart of the US 10-year yields. And then we'll take a look at the ETF GLD, which is gold, and see what that's showing us. And then we're going to go back to last week's sector, energy, because I ran kind of late doing other things. We couldn't get to more than one or two of these names. So let's go over them again because they've been moving. Right now, energy is the best performing sector in 2021. So let's see whether or not these names are worth buying and where's kind of support and resistance on them. So that'll be the lineup for today's show. Reminder that we have a weekly ETF Tactical Trader Report that comes out to clients who subscribe to it. It comes out Wednesday nights, does a lot of macro review of markets, plus gives a brand new specific ETF idea each week. We also do a monthly 7-Eleven report, whose intent is to outperform the S&P by being in no more than 7 of the 11 Spider Select ETFs. So in other words, XLE, XLB, XLC, etc. The 11 that make up the S&P, we'll have you in no more than 7, no less than 5, and with the intent of outperforming. And as of let's say December 31st. We started this back on August 1st last summer. We outperformed the S&P by 210 basis points in 5 months, which is rather significant. And instead of just simply buying spiders, this is a way to do better than the market's return. And again, that's a monthly report by subscription. My email address, rick@inthenowtrader.com. Thank you for the comments and the emails that we get each week. I appreciate it. And that's that. So let's go and talk about buying into strength. So like I said, this is one of the more difficult things to do. A stock is moving up sharply. You want to buy on a pullback, but it doesn't give you a chance to buy on the pullback. It kind of keeps going. And you feel like you're missing what's going on. And it's a name perhaps you've done your research on, and you might even have put a bid in underneath the market so that if it came down to a prior support level, you were willing to buy there. But it's just not giving you that chance. What do you do? A few choices are you chase after it. Choice B would be you raise your bid to a higher level, hoping for a pullback at what you would perceive as a level of support. Choice C would be to take it off your radar and simply just say, okay, I missed it. There's thousands of other stocks to buy, so let's go find something else. What else? What other choices are there? When we talked about chasing after it, well, I guess the other one is just to buy it at whatever level it is. And I think I've covered the possibilities of what to do. So let me tell you what I do, because one of the things I realized when I was trading on the floor of the exchange for the 12 years that I traded in the pits, and I was predominantly a stock index futures trader, but I traded lots of other commodities too. I traded gold, silver, cocoa, sugar, those in the pits themselves, as well as lots of other markets because I was on the floor and had access to everything that was nearby. Um, but in the stock index pit, by and large, and this was the 1980s into the mid 1990s, the market was moving up. And what I realized personally from assessing the trades is that I was very comfortable selling strength. I was very comfortable selling weakness in a market, looking to push it down and short and play the down move. And I'd be willing and kind of comfortable buying declines. But what I had a really hard time doing was buying the market when it kept moving higher and getting long as the market kept making new highs. By nature, I'm a counter trend player, and that made it more difficult for me to keep buying as the stock market went higher. So as I grew and matured as a trader and learned that that is a difficult thing for me, and yet the bias of the stock market over time is that it moves higher, I realized I needed to learn how to buy into strength. So let's move to charts. And here is a chart it's a weekly chart of Apple. And I've drawn a couple of horizontal lines on here that just represent potential support levels. And currently, I guess the highest green line would currently be potentially resistance because there's maybe a double top going on. But take this for the example of what I'm saying to you and not how and when to buy Apple. So I'm not giving you recommendations on that. I'm just using this as an educational purpose, and I had to pick some security. So I thought to myself, all right, well, what's the stock that pretty much keeps going higher? And one of the first things I thought of was Apple. So I'm going to put my cursor here, let's say in the middle of the screen. So at this point, you've got a breakout of highs that were near, I don't know, the mid 50s or so. And this starts breaking out. And you say, all right, well, maybe I want to buy a pullback down to here if I get it. But God, each week after week, this thing keeps going higher. What do I do? Or how do I play this? Because it's not coming back down to where I want it to. So here's what I think the answer is. And you can agree or disagree, but this is something that I found has worked for me. I know how much money I'm going to invest in a particular stock at any given time, or what I generally call one unit, because I often have an average size dollar amount of money that I put into any single idea that I come up with and I've done my research on and say, okay, here's a name I want to get into. So let's call that X dollars. That's my normal amount I'd invest in. And if I found it, the particular stock, let's say, came to where I really want to get in, I would invest that full X amount. And that's my average investment. But in a case like this, where I see something that just keeps going higher and isn't really giving any significant pullback, I've got to make a decision. Do I put in X dollars or do I put in less than X dollars? Because now I'm paying higher than I want to. And the answer I've come up with over time, and again, you may agree or disagree, but I will put in 1/3 X when I feel like I've got to partake in something that's going up, that for whatever reason, let's say I missed this kind of breakout in here in the fall of, 2019. So it broke out from, resistance, it's moving higher, but let's say I missed it. I didn't happen to see the chart at the time. So I could have more easily gotten into X amount here on a solid breakout. But now let's say we're up here and I missed the chance, but I come across this chart and say, this looks like it's going higher, but it's not giving people who want to buy on weakness any chance. So what I kind of do is put in 1/3 of the amount of money that I would normally invest. And I basically call this a close my eyes trade, in the sense that I'm buying into strength. I may be buying the top without knowing it at any given point in time. But everything else tells me this is going higher and I've missed my ideal entry. So let's put a third to work. And this way I can live with a pullback because I still have funds available if this comes down to the place I want to be a buyer. And if it doesn't, at least I have some exposure in the name so that I root it to go up. And if it comes back to where I want to buy more, great. But if it doesn't, I at least am making money on some of my position. Well, I'm making money on all of the position, but the position is only a third of what I really wanted to invest. And that to me seems like a very logical and reasonable way to approach a stock that you feel like is going higher, but you've missed your ideal entry point. Notice in 2020, the stock actually comes back right to where it broke out from. So if you kind of kept your powder dry, which is another way of saying if you left some of that X amount of dollars for a better opportunity to get in, you certainly ultimately got the chance. And this is just using, simple support and resistance lines. There's lots of different ways to come up with ways and places to buy, moving averages and Ichimoku and tons of other different studies you could use to find support and resistance and try to buy on a pullback or a breakout of resistance. But let's just say in a simple sense, you had the chance to buy. So you had a third in here, and let's say 2/3 here. And then it turned around, it broke through here, and now you've got kind of a breakout again. And even if you waited, okay, maybe it's 1 week and it's going to come right back, you notice the next week opened on the low, closed right near the high. It still appears as if this is a bullish breakout. So another place you could add, or if you didn't happen to add on this pullback, because now you feel, and I'm going to tell you, some people are going to do this, well, now it's lower than I first put in my first third, so I don't want to put bad money, or I don't want to put money into a loser, and some people think that way. Well, maybe you bought your extra 2/3 here on the breakout above this high. Whichever way you want to look at it, my strategy to you is to basically tell you that if you buy a fraction of what you have to allocate to any one individual investment, at least you have something on board. And if the market pulls back, you'll be able to find another place to add to it. And if it doesn't, you can think of this as buying another breakout, or simply keeping the 1/3 you have on it. At least you're making money on that, and go find some other stock to allocate to. But that's how I buy into strength. When something's gotten away from the ideal place that I wanted to buy, I'll still put some money in, realize that I could easily have a 10% drawdown at any given time. Just, it could happen from the day I buy it, but that's okay because I really want to be buying lower anyway. And that's this week's trader education. Let's go back and talk about the Qs, the TNX and gold. Before we do that, we're going to go to just looking at the macro sectors. So here they are in relative terms to the S&P, and actually it's to the spiders, because if you're going to look at the spider sector ETFs, you need to compare them to the relative performance of SPY, not SPX. SPX does not include dividends the way SPY would. So again, this year's best performer as of this actually would be as of last Friday's close, because yesterday the market was closed. So energy was up 12.3%, by far the biggest leader, followed by financials and materials, discretionary, and healthcare. And you can see that communication services are the worst performing sector, followed by staples. So no surprise, staples is in there. No surprise, real estate is in there. But look, technology is actually the third worst performer. So it is down on the year. The S&P, if I recall, as of was up 49 basis points on the year. So technology is trailing by about 3% year to date. And that's one of the things that people have been talking about is whether or not tech can hold up as well as it has, or as there's some move towards cyclicals, um, will you see tech be sold into and taking those dollars to move elsewhere? And right now, I'd say at least to start the year, that's what we're seeing. Financials obviously getting a good bid. Materials continue. Industrials are underperforming too. Um, so um, that part of the cyclicality is not working, but energy has gotten the big bid. It started November 1st, basically, where energy went on fire. And this sector that has been the worst performing sector, not only last year, not only in 2019, but over the last 20 years, by far the worst performing sector. You've made no money in energy in the last 20 years, whereas obviously the market has flown. So it's finally starting to get a bid. Crude oil's north of 50, and it's certainly a place to consider. And it's a place I'm considering, putting in money into. But we want to find the right places. Or is this an example also of stocks that all of a sudden started running to the upside, and we may have to just put some money into them, or can they come back to support levels? So we'll take a look at that when we go to the energy stocks. Let's just do the balance of the market overview. So we'll start with QQQ. So here's the weekly chart as I'm looking at it, and I noticed that in August we get an upside exhaustion signal. It worked for several months in the sense until we finally got higher than there. We also had one in early October. Now we have a 9 count, also a setup 9. So that's, 9s and 13s are potential exhaustion points, but the 13s are the real ones. The 9s are interim. And what we're seeing here is that, in my book, you've got to get above 335 to kill these 13s as being active kind of potential upside exhaustion places. But I'd really want, if you really think the market can top, the first clue that you're going to get in the form of the Qs is that you get a qualified and confirmed break beneath 301.60 on a Friday close. That could not happen this week. It could not be qualified and confirmed because last week was a down close relative to the Friday before. If this week closes above last Friday's close of 311.86, and then next Friday you close underneath 301.60, if the following Monday opens lower and you during the course of the week you have a lower low and lower close come the following Friday, meaning next Friday, then you finally have a proper break of this level. It would initially target 283 with a bigger downside 247 projection. So in the meantime, what this says to me is that certainly we're in a place stocks can pause. Do I want to be buying the Qs or Q-related component names up here? Basis this chart, it's obviously you're buying into strength. So if you've got no position on it all, you have to decide, do I want to buy here or do I want to wait for pullback? Same type thing. If you have no exposure at all, if you're bullish the stock market over time, you could buy a little bit. I'm not buying anything up here personally. MACD is potentially crossing lower again. It's not there yet, but I'm not buying. If I'm buying stocks, I'm buying pullbacks. I'm not really buying strength at this point. That's my view on the Qs. Let's move to TNX, the 10-year. So here's a daily chart of the US 10-year. The breakout occurred above 64.5, what was it, 78 bips. It was here, so it was the proper breakout above here that told us we were going higher. We had an upside target of 94 or 9.38 in terms of TNX, basically 94 basis points. What we got there, we had a 13, so we exited the yield play, which was essentially shorting bonds, pulled back, went sideways, and then broke out to the upside. So we hit the stop out level from the 13 at 11.3. It's been pausing there. And for right now, the high tick and yields got up to 118 and change, almost 1.19%. The low was down near 40. So, Fibonacci retracement on 38% gets you down here at about 89 basis points, the lower end of that trading range. So that should be support. So even if the trend line broke, I'd still expect to see some support right near 90. As far as upside targets, this is about 1.3%. This is 1.37%. And this is 1.41%, all active targets on the upside. So I would be a buyer in a pullback. In yield terms, there's an unfilled gap here. Often gaps do fill themselves. It may take time, but somewhere if we came down in there, I probably think that's not a bad place to buy the yield chart, which is the same thing as saying selling bonds. Let's move to, what do we have next? Gold. So here's GLD. Peaked in August. Been playing a dance since, but you can notice there is a downward bias here. Even this rally here failed to take out the high of this rally. This rally failed to take out the high here. This failed to take out the high here, and this failed to take out the high here, which is, so every rally has been lower to this point. So that's a negative for gold. We continue to hold the GLD TDST line at 168.73. There's one minor breach here, and they came right back. But what happened, and I was quoted in Bloomberg on this last week, this was a failed upside breakout. It wasn't qualified and confirmed. It suggested a failure up here in gold itself. In gold futures terms, that was at 19, I think it was, I can't remember, it was 1927 or 1937. Nonetheless, it was an upside failure. And then, we've sold off. Now, we've got some important support right here in the 168 handle. We're already on a daily setup 7 count. We could get some bounce over the next few days if we continue closing less than the close from 4 days prior to finish out this 9 count. And then you have a big decision to make, which is, do I buy the setup 9 and assume that's the bottom, and then stop myself out, probably under this low? Or is this 9 count the beginning of a full 13 count that's going to take this lower? Either way, my guess is if you're a trader, you probably take the chance to buy somewhere down here, and you risk beneath that low. That way you have a very tolerable downside risk with the chance that you've kind of bottom fished and caught the bottom. And of course, the dollar is going to have a lot to do with if that's successful or not. So you've got to watch the dollar. All right, let's get to, we've got a little over 5 minutes left. Let's get to our charts on the energy sector. I'll get to as many of these as I can. I think we looked at this last week, but I'm just going to review it again. Chevron breaking out. So it previously broke out from this line. Here, I could just draw it again so you see, this downtrend line previously broke in fourth quarter. Then we made a high, which pulled back. We drew another downtrend line. That's been exceeded to the upside now. So it makes me think that at a minimum, we're getting to 98.86, and a bigger upside move, we're talking 114 to 117 for Chevron. In order for it to get there, I suspect that oil is going to have to get much higher than where it is now, and I still have trouble justifying oil being where it is. In fact, today, there's a major report out that they're lowering the oil demand numbers for 2021, and yet oil is still up today. So kind of goofy for me that continues to happen. Exxon, double bottom, the second bottom on 13s and 9s. That was, for me, a much easier buy and an easy way to peg a bottom. We got to the first propulsion exhaustion level, pull back. Now we're up into the cloud. If we can exceed the cloud, next level up there is 56.36. So you just have to be aware that you're already within the context of the bar that made the high here. So this is a successful test. We are testing the highs from last June. A little tougher to be a buyer, but as of right now, still looking okay. ConocoPhillips starting to break out above the cloud here too. That's good. We're still a few weeks away from, I don't know where this line came from. It just kind of mysteriously has shown up. So here, let's see. Nope, don't know. Just kind of one of those goofy software things. Looking decent. Got to look at here trend lines that are still in play. So look, in a few more weeks with strength, we're going to run up against the trend line. We'll have a 13.2. That'll be kind of an important inflection point. Anywhere from the mid 50s up to 57.5 probably is resistance, but like all the other energy names, right now they're being bid for. I don't even see a place that's nearby that I could tell you it's bad underneath because it's moved up so much. So I guess you'd want to see this interim low here hold on any pullbacks. Schlumberger. Also, stalling against the top of the cloud, propulsion, full exhaustion level. A thrust here gets you at least another few weeks of upside, and percentage-wise could get you from 25 up towards 30ish, which on a percentage basis is pretty good. Problem is you have to risk as much from here if you first buy it now. There is, earliest support is 23 and change. Then the bottom of the cloud would be more, but the bottom of the cloud falls over the next month or so, and really the stronger support is right near kind of 18.5-ish, give or take. That's probably a better place to buy if you get the opportunity. Kinder Morgan also up against its cloud propulsion exhaustion level, needs to, you thrust through 16, you've got a ways to go before you hit 20. That's a 25% possibility on the upside. So I'd look for the moves higher to think that, I'd rather pay, actually, just so you get it here, I'd rather pay on one or two Friday closes north of 16 than pay the current 15.68 because it's still against resistance. I'd buy a break out there. Let's see. EOG. Starting to break out above its cloud. That's good. It's got room up to 66.60. Same thing though here, tougher to figure out, from current levels, you could fall down as much as move higher. So the trend, let's say the trend's kind of your way here for potentially higher levels. Looks like the trend lines. So that one's broken and that one is just nudged above. So I say you play for the breakout. So you buy a little and you buy some more on pullbacks. PSX, Phillips, this is stalling here against, look at the 9, turn on a 9, turn on a 9, turn on a 9 here. The only 9 it didn't turn on is this one. Turned pretty darn close to a 9, so we're on a 9 here. I'd rather also pay above 80 to get long than to pay here, because you could easily pull back to the mid 60s. So maybe you buy some on a breakout above, Friday closes above 80, you buy some, and then you buy more on pullbacks. Let's do Valero. Same type thing. Look how often turned on weekly 9s. That's 9 consecutive weeks that it closed. In this case, 9 consecutive weeks closed above the close from 4 weeks prior. This is 9 consecutive weeks it closed beneath the close from 4 weeks prior. So you see this does a lot of 9s. Right now, same thing. Rather buy above 66.5 than here, but this is actually close to the support, so you buy a little here, you buy more on a pullback, and you play for 78 to 80. That's it for this week. Hope you enjoyed the show. I'm Rick Bensignor. This has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.